production house of the world has already shifted. What the West has left is the financialization, and that financialization is backed by debt. As the two of those collapse, you will have that imbalance will be restored.
And we think the next 10 years will sort of replicate what we saw from about 2000 to 2010, 2012. These slides here really represent, I guess, from a macro perspective, the sort of sectors and markets, themes we're invested in. The first one, the top left-hand corner, that's the CRB commodity index relative to the S&P 500. You can see their commodities even more unloved, out of favor, even compared to where it was back in the days of the so-called TMT bubble in 2000. So nothing's changed, unloved, unwanted. If we go to the right-hand corner, this is small cap value, the Russell small cap value index relative to the S&P growth index. So small cap value stocks relative to large cap growth stocks, as unloved as they were in 2000, even more unloved than they were, just as much as they were at the height of the coronavirus sell-off. Sort of related to all these is commodity producers. That's the bottom left-hand corner. Commodity producers relative to the S&P 500. So this would be your Freeports, Exxons, and the like, relative to the S&P 500. There we go, as unloved as they were back in 1999, 2000. And now
that's a long time ago.
It's a long time, and that's one thing to be as unloved as they were back then. They've also been in a bear market from a relative perspective since, well, pick whatever, 2010, 2011, 2012. It's 10 years plus. It's been a ferociously bear market. So we're investing in these things that are really, really unloved, out of favor. Even though we've done okay in our portfolios, as we've seen, it's only just getting into gear. And we think the next 10 years will sort of replicate what we saw from about 2000 to 2010, 2012. It didn't go in a straight line, and a lot of patience is required. It's all very easy looking back on things and going, oh yeah, well, that's, when you're on the coal face, it's a bit different. Now, a lot of our investments are set outside the US, and particularly in emerging markets, small caps and emerging markets. That's where the value is. So we take the first one on the top left-hand side. This is the MSCI World relative to the S&P 500. Buying stocks outside the US is not exactly a popular pastime. Probably just as bad, if not worse, is emerging markets versus the S&P 500. Emerging markets are as unloved relative to the S&P 500 as what they were at the height of the long-term capital crisis in 1998.
And folks,
hence... Yeah, go ahead, Chris.
I was going to say, folks, this is important because there's a massive arbitrage that we have in front of us. And what I mean by that is, if you look on a global basis for the last 20 at least years, what we've done in the West is we've outsourced production to the East. Okay, so average businesses are now, the production house of the world has already shifted. What the West has left is the financialization, and that financialization is backed by debt. As the two of those collapse, you will have that imbalance will be restored. And if you look at this from the perspective of basically global GDP or certainly purchasing power parity, that chart on the bottom left, it's a little bit old actually, but the numbers are actually a little bit higher. So you've got Chinese GDP, which is actually over 19% now, not 18.5, but it doesn't matter. It's on a relative basis, you can see this divergence between where the actual, where things get made. And that's wealth, that's actual wealth. And then if you look on the chart on the right, now this is the financialized world. This is what we're looking at from the perspective of production, GDP, compared to the actual market caps. So the interesting thing to look at here is that China has almost 20% of global GDP. The US has 15%. But if you look at the market cap weighting, China's only got 2.6% and the US is 63%, right? That doesn't make sense. It's basically made up by this financialized world, which is backed by debt. So that's the important thing. when this collapses, and we are already in the beginnings of this collapse mode, it is why they're trying to implement central bank currencies. It is why they're actually taking the world into war, because it's the only methodology that they have left in order to try and retain that level of power. Again, this is not any different to the collapse of the Roman Empire or many of the other empires. We're at this critical point in time where this is what's happening. Our positioning, hence, is in basically what China is buying. There was just the other day, I think it was Kapi was saying, he keeps things very simple, and he said, just buy what China's buying. China's buying gold, buy gold. So to a certain extent, where we're invested, as Brad, you referenced, we're invested largely into markets outside of the US, but very specifically, we're invested into asset classes as well that have that supply-demand imbalance. If you look here, folks, and again, this shouldn't be any surprise to you. People know this. At the moment, they're forgetting it. Right now, they're forgetting it because they're looking at the markets getting sold off. They're looking at CNBC, or I don't know, I'm not quite sure. There's a lot of noise, and everyone's trying to have their opinion around what's actually happening. And most of them, I think, are missing the large points. And those large points are these big trends that we're talking about. So, again, share of global GDP, you can see in the top left corner there, you've got that red line is manufacturing, world gross output. China is in the red line, and the US is in the yellow line, and the others are the other sort of periphery countries. You've got Japan, Germany, Britain, and so on and so forth. The little chart just next to it is that coinciding there at the end, where you've got China catching up to the top 10 ex-China countries. And of course, pretty much the same thing, which is your BRICS versus G7 on the right. So the BRICS have now already overtaken the G7 countries. Again, coming back to what I just spoke about before, this is important because the BRICS and what they're invested into and what they produce is vastly undervalued relative to the G7. Remember, go back to that previous. There we go. Okay, so, China, 19% of global GDP, and it's only 2.6% of market cap weighting. US, 15% and 63%. It's the same thing with respect to the G7 countries. So the G7 still have large market caps where there's a value being attributed to those countries and the various equities and so on and so forth in them. When really we've already outsourced all the production. The entire production house is sitting largely in the East. And guess what? Now these Muppets have decided that they're going to go to war with them. You're going to go to war with your production house? It's insane, but that's what they're doing. They're going after China. They're going after largely these aligning countries, and they have to align in order to just survive, right? Because they don't want to be taken over, either militarily or economically, by the West. And so we're in this conflict zone, and that brings up the other topic, which is war. At the moment, you would think that people would be looking at the fact that we have a conflict between Israel and Iran brewing. The US has just taken 2 battle carriers into the Persian Gulf. We've got British streets on fire, and no one's really pricing war. They're all worried about the unwind of the carry trade. I mean, it's insane. It's like, forget about the short-term noise. These things are much, much bigger as problems to markets than the fact that the Bank of Japan raised by 25 basis points and a bunch of people got caught on the wrong side of the trade and they're unwinding their trade. They'll unwind the trade, that's fine. And governments are going to do what they're always done. They're going to go, oh shit, we don't know what's the policy measures. Well, they're going to have to cut interest rates, and that's just going to send inflation flying.